Tom's Trade Rules, rule number 17. Keep it simple. Simplify to multiply. Simplify to scale. If you want to grow your account in a consistent, repeatable, and mechanical fashion, you got to keep it simple. People simply will not stay with something that is too complex. So let's look at the benefits of keeping your trading simple. Let's talk about reduced complexity. Simplicity helps reduce the complexity of your trading strategy. Complex strategies can be difficult to understand, to implement, and to monitor. When you keep it simple, you're going to have a clearer understanding of what you're doing, making it easier to stick with your plan and avoid costly mistakes. The more complex the trading plan you have, the harder it is to stick to it, the harder it is to implement it and stay with it over the long haul. I've been trading for 35 years now, and I've seen a ton of different trading strategies put out there by all kinds of supposed experts and gurus and so forth. I bought a lot of different trading kits and systems. Man, some of these are super complex. You got to load all kinds of crazy charting things and dots and things appear and triggers and alerts and do this. And then when this happens, you got to do X. And if X happens, then do Y or Z, depending on what G does. Who knows? The harder it is to pull off the trade, the less likely you are to not only have success with it, but B, to stick with it for the long term. You got to have a simple, in my opinion, you got to have a simple plan of getting in, getting out, and making it easy on yourself to trade. Consistency. Simplicity promotes consistency. If your trading strategy is straightforward, you're more likely to apply it consistently over time. Consistency is the key to allowing trades to play out over time that have positive expectancy. Okay? You got to be consistent in putting those trades on over a period of time, over and over and over again, so that you can let that positive expectancy play out. Simple strategies are easier to execute and stay consistent with, especially when you're dealing with larger positions or multiple trades simultaneously. Complex strategies or strategies that have lots of adjustments may involve intricate calculations or the use of multiple indicators, which can become cumbersome and make it hard to be consistent. I don't want to sit in front of my computer all day long and try to figure out the 19 different adjustments on the 40 different trades that may be working properly. I like to have fewer trades, simple strategies that I can get in and out and not spend all kinds of time in front of my computer during the day. I'm not everybody, so you got to do what's right for you. But in my opinion, consistency in trading is key. And if your strategy is too complex, you will never be consistent and you'll never make consistent gains in there. You're going to hit a couple home runs and then you're going to strike out a whole bunch of times. Emotional control. Simple trading strategies are easier to follow, even during periods of market turbulence and uncertainty. Emotions like fear and greed can cloud your judgment and lead to impulsive decisions. A simple strategy with clear rules can help you stay disciplined and avoid emotional trading. When you know you have a ton of different adjustments you can make, sometimes you start to make adjustments just for adjustment's sake. Well, when do I actually put this adjustment on? Well, I feel like my delta is getting a little out of whack, or I feel like my theta is too here, or I need to adjust this trade because it's starting to move towards this. Now you're letting emotions get into it because you're not simply mechanical in your efforts. Okay. You're now basing things on a little bit of emotion because now you have to have a feeling of when to put on certain adjustments, maybe not exact specific. So you can get your emotional control back by having simple trading strategies. Performance evaluation. Simple trading strategies make it easier to evaluate your performance. We've talked about this in other rules, tracking your performance, having a daily tracker, looking at that weekly, looking at it on a monthly basis. Simple strategies make it easier to evaluate your performance. When you've got dozens of different adjustments in that trade, it's really going to be hard for you to put any of those into any kind of a tracker out there and really monitor what you did. There's only a few different tools, in my opinion, that are out there, OptionsNet Explorer and a few others, that maybe you can put those trades in. But how can you evaluate trades over time when you're constantly making adjustments or changes to them? How do you know that your original trading plan was actually a good one to begin with? So you can clearly define your goals and measure your success or failure against your goals when you have a simple strategy that's easy to evaluate your performance. With complex strategies, it's often very challenging to pinpoint the actual source of success or failure when you're making all kinds of different adjustments. All right, simplify to scale. Talked about this at the very beginning. Simple trading strategies are generally easier to scale compared to complex ones. Same thing when you're running a business. If you're running a business and you want to scale your business, you got to keep it simple. It's very difficult to scale an extremely complex business that doesn't really have a defined plan. Okay? When you're doing all kinds of different things, how are you going to scale all of those things? If everybody's doing something different in your business, how are you going to scale when there's no set strategy for your team? So scaling and trading refers to increasing the size of your positions or the number of trades you make to accommodate the larger capital base. Simple strategies are typically more scalable because they have clear, straightforward rules that can be applied consistently across a range of assets and asset classes, different time frames, and market conditions, which means you can easily replicate your strategy as your capital grows. If you have simple strategies that are mechanically reliable and consistent, you can scale a whole lot easier as you grow. Simple strategies are more adaptable to different market conditions, which is going to be essential when you're scaling. As your trading size increases, you may encounter various market environments, and simple strategies can often be adjusted more easily to accommodate those changes. And lastly, I use the KISS principle here, but it's different than your standard KISS. The KISS principle for me is keep it simple and scalable. I use this in businesses as well. Keeping it simple in trading promotes scalability, emotional discipline, and consistency. While there's a place for complex strategies in certain trading styles, simplicity is a good starting point for most traders, especially beginners, as it helps reduce the likelihood of costly mistakes and any kind of emotional decision making. If you want to grow your account, you need to keep it simple. Bottom line here, keep in mind the KISS principle, keep it simple and scalable. The simpler you keep your strategies, the easier it is to grow, the easier it is to scale, the easier it is to manage, and the easier it is to make a lot more money in the long term. I hope this was helpful for you. If you like it, go ahead and click that like button. Subscribe if you're not a member already on my YouTube channel, and we'll see you guys on the trading floor. Rule number 17, our last and final rule here of the 17 core trading rules. Take care, everybody, and great luck in trading.